People who got variable rate mortgages in 2020 and 2021 got absolutely slaughtered when the Bank of Canada increased interest rates. And now that it seems like interest rates may start to come down, people are starting to look at variable rates again, thinking, hey, what could go wrong? Rates don't have anywhere to go but down, right? Well, maybe, maybe not. And in this video, we're going to discuss why you shouldn't choose a variable rate mortgage this year. And the reasons why might surprise you. But before we get into it, my name's Nolan Matthias, and if you want the latest Canadian real estate and financial information, this is the place for you. So do me a favor, hit that subscribe button and hit the like button so more people like you can see this video. And if you're looking down and you're going, hey, I thought I subscribed to this channel, but it's showing me as not subscribed, well, that's because this is a second channel dedicated to the Canadian real estate space. So if you haven't subscribed, make sure you hit that subscribe button. Okay, so let's get into it. Let's discuss why you shouldn't choose a variable rate mortgage. And this is regardless of year, this is regardless of the timing. This is purely a video on whether or not you should choose a variable rate mortgage and how to determine if it's right for you. And I need to start by prefacing that the choice between fixed and variable is a choice that is predominantly based on risk tolerance. Because no matter what you think the market is going to do, or no matter what economists and pundits are saying is going to happen with interest rates, it all comes down to your interest rate risk tolerance. Because if you think back to 2020, 2021, 2022, when the Bank of Canada was saying interest rates would remain low for a very, very long time, well, we were very quick to learn that sometimes the forecasts aren't actually what happens, which is why when you are choosing between fixed and variable, you need to choose based solely on your risk tolerance, and more specifically, especially if you're looking at variable rate mortgages, how much you can afford your budget to fluctuate over the next 3 to 5 years, depending on the length of mortgage that you get. Now, knowing all that, there are some general rules of thumb that will help you choose between fixed and variable rates. And let's start with the first piece here, which is if you think interest rates are going to continue to go up, or maybe not come down enough for it to be worth it for you to get that variable rate mortgage. And before I go any further on this piece of the topic, I need to preface this with, if you are trying to time the market, you're probably making a mistake to begin with, because the ability to time the market, even when it seems clear that expectations are in one direction or another, is very, very difficult to do. But if you do think that interest rates are going to go up rather than come down, well, it definitely makes sense to start looking at a fixed rate mortgage. But on top of that, if there's a significant gap between fixed rates and variable rates, well, you need to take that into the equation as well. Because for example, if variable rates are priced significantly higher than fixed rates, and I'm talking about 1% or more higher here, well, the chances of interest rates coming down enough to make a variable rate bet worth it get lower and lower. So for example, at the time of this filming, you can get a variable rate for about 6.15%, and you can get a fixed rate for about 5%. Now, you might think, oh, interest rates are definitely going to come down at least 1.25%, but they actually need to go down significantly more than that for your variable rate mortgage to be worth it. Because not only do you have to make up all the time that you spend at an interest rate that is higher than the fixed rates, but you're also going to have a pretty significant amount of time where your interest rate is lower than the fixed rate you could have eventually got in order to balance things out. So even though you might think, oh yeah, I think interest rates are going to come down by 1.25%, it's more likely that they have to come down almost 2.5% in order for you to end up better off or even break even if you were to choose that more expensive variable rate. Now, on the other side of the coin here, if variable rates are significantly cheaper than fixed rates, well, it often makes more sense to have a variable rate mortgage, but the times when they are priced higher are definitely not times where you want to be considering those variables, unless you have some sort of crystal ball that tells you that rates are going to come down significantly. Now, the second reason why you may not want to choose a variable rate mortgage, if you know it's going to keep you up at night knowing that your interest rate and therefore your payments could change pretty much overnight. And this happened to a lot of people in 2020, 2021, who chose variable rates thinking, hey, it's not going to bother me if I get a little bit of an increase in interest rates. And of course, yes, there was a significant increase in interest rates. And a lot of people who had the proper variable rate mortgages, which is the ones with the adjustable payments that you don't get at a big bank, well, a lot of those people ended up having their payments increase significantly. And what's worse is the people who got their variable rate mortgages at the big banks who have fixed payments are about to see their payments go up even more pretty much overnight when their mortgage comes up for renewal. This is what we call payment shock. So if the prospects of those payments going up significantly, either as the Bank of Canada increases interest rates or as your mortgage comes up for renewal, are disturbing thoughts to you, then that may be a sign that variable rates are not right for you. Now, the third reason why you may not want to consider a variable rate is if your partner doesn't feel comfortable with a variable rate. This is one of the primary ways that we determine with couples whether or not they should be choosing variable or fixed. If the prospects of those higher interest rates bothers one of them, or they don't have the risk tolerance to take a variable rate, well, that could be a recipe for disaster, not just from a sanity standpoint, but also from a marriage standpoint. And we've always said we're not in the business of breaking up marriages. So if one partner in a relationship doesn't feel comfortable with variable rates, it's often a really good idea to go fixed, or perhaps go with a shorter term fixed rate. And that leads us into the fourth reason why you shouldn't consider getting a variable rate, and that's if you can get a 1 or 2 year mortgage for significantly cheaper than what a variable rate mortgage would cost. My wife and I did this in about 2011. We were able to get a 1 year or 2 year mortgage. I can't remember which one it was, but it was cheaper than the variable rate at the time, therefore locking us in at a lower interest rate and allowing us to save some money. And yes, it was still very much a floating rate strategy. It was just on a 1 or 2 year term, as opposed to it happening whenever the Bank of Canada changed interest rates. And the fifth reason why you shouldn't get a variable rate mortgage is if you don't understand the different types of variable rate mortgages. This is really, really important. And you've heard me talk about fixed versus adjustable payments. This is the primary difference between a lot of variable rate mortgages. The big bank mortgages tend to have fixed payments. The smaller bank mortgages tend to have adjustable payments. And by the way, the adjustable payment options are almost always a way better option because when interest rates go down, your payments reduce. But more importantly, if interest rates go up, your amortization remains the same and you continue to pay down your mortgage and avoid potential payment shock somewhere down the road. And on top of that, if you're getting a variable rate mortgage with a big bank, you have to keep in mind that if you do decide to lock in, you're probably going to have to lock in at a very high interest rate. So knowing where to get a variable rate mortgage that has a beneficial lock-in rate if you decide to do that is hugely important. And the way that you do that is by finding a mortgage broker that you can trust who will make sure that you have the exact right product for you. And if you don't have one that you can trust, reach out to me and my team at mortgage360.ca. We'd be happy to help make sure that you get the right mortgage and fully understand the mortgage that you get, while at the same time being protected from any blind spots and surprises that you may not know to look out for. Oh, and make sure that you watch this video right here, the next one in the series, which is the reasons why you probably shouldn't choose a fixed rate mortgage.